And now, it's Boomer Life, lifestyle discussion designed to make your life more engaging, meaningful, and complete. Celebrating the baby boomer generation, this is Boomer Life on Oct6th2015.
The best things in life are free, but you can keep them for the birds and bees. Now give me more.
And welcome to Boomer Life on Oct6th2015. I'm Joanne Sutton. A well-thought-out plan for your financial future is an integral part of building the life that you want for both yourself and for your family. And today we're talking about your financial future with JimDoyle, Senior Financial Consultant with Investors Group Financial Services, Inc. Jim has over 25 years of experience in this role. Now, Jim, you hold the Certified Financial Planner designation with additional designations as a Chartered Life Underwriter, a registered trust and estate practitioner, a certified divorce financial analyst, a certified international wealth manager, and you're also a graduate of the UBC Sauder School of Business Family Enterprise Advisor Program. Sounds like you were in school for a long time. Just want to say welcome back to the program, Jim.
Thank you, Joanne. It's a pleasure to be here.
Now, just before we start, I wanted to extend an invitation that if you would like an opportunity to meet Jim, he's actually going to be out and about on location, Van Dusen Botanical Gardens, tomorrow, Wednesday, October 7th. It's all part of the Tapestry Foundation's Seniors Lifestyle Tapestry Talks, and I believe you'll be at this event from 10 until 4. So tell me, what are you looking forward to about this type of event, Jim?
You know, this is a really stressful time for a lot of families that they're dealing with stuff they've never had to deal with before. And what a wonderful opportunity to meet people and have a significant impact and steer them in a direction to make some of these choices.
Oh, it's great. A great chance to get out in the community. So last show, we talked about helping university students to develop essential financial skills as they start out in life. We also spoke about the problems faced by what we call the sandwich generation. And if you're not familiar with that term, the sandwich generation is those of us who might feel squeezed between the needs of your own life and the needs of their kids and the aging parents. So you somewhere get stuck in the middle. So we're going to start today's show with the importance of keeping an eye on your investments, given what's going on in today's markets. So Jim, in your experience, what do you see as some of the biggest vulnerabilities in the average Canadian portfolio?
I'd have to say there were probably two items. Complacency around some of the interest-sensitive investments. It's important to keep on top of things that could affect your bond returns, since returns are already limited and rising interest rate could hurt you. The second vulnerability may be around over-concentration or a home bias towards Canadian investments. We see this a lot. I'll address the complacency issue first if I could. When you buy a term deposit, you know exactly what you're going to get, either in terms of monthly income or annual interest, and what your principal will be at maturity. When you talk about owning bonds, they're interest-sensitive investments. They may have a stated rate of return, but the value of the principal could go up or down.
Jim, could you actually elaborate a little bit more on this for us?
Well, some of our listeners may already know this, but a typical bond is going to have two components: the face or principal amount that you've invested, and the coupon, which is the interest amount that the bond is scheduled to pay. So let's imagine you're holding a $10,000 corporate bond that pays 4% annually. If you hold this bond to maturity, you'll get your $10,000 and 4% interest at maturity. Your yield on this is 4%.
We often hear about bond yields falling or rising. Is this what you're actually talking about?
Exactly. So let's imagine interest rates were to rise to, say, 4.5%, and you wish to cash your bond in before maturity. And that's a reality for a lot of people. The market value of your 4% bond goes down, and you could get less than the $10,000 you invested. It's important to remember, the longer the remaining term on your bond, the more you might potentially lose. In my experience, in this low interest rate environment, we've been seeing an appetite for higher yielding bonds. And this demand for interest-sensitive investments could create a not-so-pleasant outcome when either interest rates or inflation start to rise. Here's a bit of information worth paying attention to. Most mortgage money that is lent out these days is raised through bonds. So when bond rates go up, mortgage rates are not far behind. Even if you don't own bonds, rising rates could mean that mortgage yields are heading higher.
So this answer gives us a bit more understanding why complacency around interest-sensitive investments could actually harm you. What can you offer us in regards to being too heavily invested in Canadian investments?
If I could, I'd like to qualify this point. For some people, investing heavily in Canada could be the right strategy. Diversification is one of the key cornerstones to successful investing. An additional element is geographic diversification, or investing outside of Canada, but you want to get some advice on this first.
So are we actually missing out on anything if we happen to be overweight in Canadian holdings?
Ultimately, we're missing out on growth opportunities in other areas. What's been interesting so far this year is that many people perceive Canada as a resource, commodity, and energy market. With the Canadian dollar lagging behind or against the U.S. currency, there's been an opportunity to make a little money by having assets invested outside of Canada.
What are some other areas of overconcentration?
Well, Joanne, an area of overconcentration could be in your RSPs. As you may know or you may not know, RSPs no longer have a foreign content limit. Many Canadians still might be significantly overweight in Canadian holdings without even knowing it.
So you might suggest revisiting your current investment selection just to make sure that you're not missing out on any other opportunities?
I'm not sure if I've mentioned this strategy before, but portfolio rebalancing is one strategy that makes sense to me.
Would you mind reviewing this strategy one more time, for maybe some listeners who might have just joined the program, or some of us that simply cannot remember and we need a little bit of a reminder?
No problem. Imagine you hold a portfolio with a typical 40-60 split. Now that means 40% in fixed income investments. Now these are your interest-bearing investments such as bonds, and 60% in equities or stocks. As an example, if the equity market declined so that you ended up with a portfolio that had 50% in equities and 50% in bonds, and it should be noted here, this is a shift from your usual mix of 40% fixed income and 60% in equities. In an effort to protect your portfolio, you might want to rebalance back to your original mix to make sure that you're still comfortably within your own risk profile.
Well, to me, it sounds like a little bit of fine-tuning, but definitely there's some merit to this rebalancing strategy.
Joanne, let me put it this way. If your overall risk profile has changed as a result of a market downturn, rebalancing back to your original asset mix might make sense as a form of portfolio protection.
I actually like this proactive solution that you've offered us. It's a terrible feeling when our portfolios are going down and we feel helpless that there's nothing we can actually do about it.
I know this sounds a bit contrarian, but there could be a silver lining to be found, financially, by increasing risk at a time when the markets are low. Remember the adage, buy low, sell high.
Likely best implemented with the help of an astute advisor.
Well, Joanne, do you know one?
Well, I'm looking at one.
Keep in mind, this rebalancing strategy doesn't apply to everybody, but you may want to explore whether taking some of your assets from your fixed income or interest-bearing investments and moving them into the type of assets that have just dropped is the right strategy for you. This way, when the markets recover, you might have an opportunity to have made some money from the downturn.
Well, for a lot of our listeners, Jim, the events of the past several weeks were starting to have a sizable impact on their investment portfolios. I know it happened to myself, but is there a message of hope that you can actually offer our listeners right now?
In my opinion, investors can turn a down market to their advantage. One of the biggest challenges investors face, however, is they're fearful of doing the wrong thing, maybe making things worse. Unfortunately, they end up doing nothing at all. Emotions often run high in a bear market, and they play a big hand in influencing investment decisions. It's how we manage these at times like this that can have a significant impact on how we fare financially long term. This is where I can help.
It all seems very emotional, and if there's anything that I've been hearing over the past couple of shows is the role that emotions play in terms of how we make our investment decisions. Without keeping them in check, the emotions I'm talking about, they probably have more influence than they actually should.
It seems simple, but at times of market duress, it really helps to hear from your advisor. Their job is to provide reassurance, to let you know that you're in the right investments and that your plan is solid, or that there are certain adjustments that you may need to make.
So a couple of questions for our listeners might be, what do you think your advisor relationship should look like, or are you sure that your needs are being met?
Joanne, I do believe this could be a good time to ask these types of questions, and I do believe it's important to understand that there are a number of different investment advice models out there. Be clear as to whether you're seeking investment advice alone, research and selection, and help on the transactional side of the equation, or whether you need a comprehensive financial approach that deals with all financial aspects of your life. I believe your investment selections should be driven in large part by what your needs are, not only today, but in the future. That is why a written plan is a cornerstone of client engagements in my practice.
Jim, hold on to that thought because I look forward to continuing this conversation. You're listening to Boomer Life on CL650, and I'm Joanne Sutton. Today we are speaking with Jim Doyle, Senior Financial Consultant with Investors Group, and we're talking about your financial future. But I'd like to remind our listeners right now, here's an opportunity to actually meet Jim. He's going to be on location at Van Dusen Gardens tomorrow, Wednesday, October 7th. It's all part of the Tapestry Foundation's Seniors Lifestyle Tapestry Talks. It runs from 10 until 4. If you would like to learn a little bit more about Jim Doyle and how he can help with your financial situation, please give him a call toll free. The number is 1-800-665-7178, or you can call him locally at 604-682-5431. Did you know that people who follow a written financial plan express higher levels of confidence and satisfaction during these down markets? Stay with us. Jim offers his tips on developing your own financial plan. That's coming up next on Boomer Life on CL650.
Celebrating the baby boomer lifestyle. This is Boomer Life on CL650.